the David Gaud, Senior Portfolio Manager, ex-Japan with Edmund D. Rothschild Asset Management, who joins us live from Hong Kong. David, good morning and thank you for joining us. First, characterize the global equity environment for us. Emerging markets are outperforming developed markets, but in last 4 or 5 days, developed markets also have made a roaring comeback.
Yeah, no, absolutely. It's been quite an interesting month we've seen so far. And the performance of the US and I think more importantly from Europe are actually extremely interesting. And although, as you mentioned, you know, from a macro picture, I mean, the US numbers are still not that convincing. We think that there is a strong emphasis which will be put on Europe. Why we think there is a strong case on Europe is that this is a market which is still trading at a massive discount to the US, and yet we start to see a lot of actions among the countries and most particularly among the corporates. If you look at the M&A frenzy which is carried on in Europe, across Europe currently, this is extremely interesting because when you look at European corporates for the past 12 months, actually the margin has been very steady, but what has been missing is the top line growth. It's revenue growth. And thanks to the M&A angle, we're now seeing companies who are putting their cash to work and they are gaining, they are acquiring more revenue, they are acquiring more market share, new markets. And this is probably what's going to create that momentum across European corporates. And so for that reason, you know, that big spread in valuation we see between US corporates and Europe corporates probably is going to narrow over the coming months. And this is why Europe probably offer a great investment case at this stage. For the emerging world, as you said, you know, this is not an easy picture because there are a few countries where the earnings momentum has been actually positive year to date, and India is one of those countries, along with the Philippines and Thailand. For the rest, we're still waiting, and China in particular on the corporate side have been relatively disappointing. It's not a surprise, but clearly the margin expansion is not happening, and the top line growth is barely in line with, you know, the original expectation. So it's difficult to see, you know, a strong momentum coming from the emerging world as a whole.
David, what's the sense that you're getting about the dollar index? Because that recently hit a 2-week high. What's your view on how the dollar is likely to shape up and its impact on emerging market Asian currencies as well?
But, you know, I mean, in the absence of real momentum on the macro side coming from the US, we know that the Fed is going to tighten, but we still have time. And we know that it's been a very crowded trade to be long US dollar, you know, expecting a re-rating in the US dollar versus other currencies. This did not happen. On the other hand, and again, talking about Europe, you know, if you look at the euro, why it's been so strong, it's because we've seen a continuous inflow from outside into European assets. And as I mentioned earlier, we expect this to continue. So the euro will probably remain strong. And for the emerging market currencies, some of them are recovering, have started to recover, and they will continue to recover. On the one hand, you've got the yuan, the Chinese yuan, which is weakening further. So we know that carry trade, you know, investing into domestic assets, benefiting from the yuan appreciation is actually slowing down. So there is a potential outflow. It's probably going to go to other emerging market currencies. And India could benefit. Indonesia also has been benefiting. So it's really based country per country. We have to be extremely selective at this point, but we would rather stay long euro at this stage and long in some emerging market currencies, but specific ones.
David, you have a decent exposure to India, and what you like within India are largely export-oriented businesses or export-dominated companies. Given the way how Indian markets have appreciated from the recent low, are you still a buyer in Indian stocks?
Based on the overweight call on India, yes, we still maintain our exposure to the export names. But what has been extremely interesting is that we've been able to add some domestic exposure now. And in particular, we've been adding more exposure to the private banks. And the results, you know, published last night by HDFC Bank are extremely interesting because they were extremely strong. Whatever the number you look at, you know, if it's in terms of cost to income ratio, in terms of loan growth, in terms of deposit growth, This is a bank which, and it's not the only one, but it is one of the private banks which has delivered actually extremely strong results. And they explain why, this earnings momentum in India is carrying on, and there is no revision downwards into FY14 and FY15. I'm talking about fiscal year here in India, and that momentum is definitely, in our view, going to maintain the outperformance of the Indian market versus most of the other markets in the world. And so for that reason, we've been very much positive on the export story, which is still very much there. Though you're right, the valuation is a bit expensive, but now it's time to move into more domestic. But it's not taking profit out of the export into the domestic. It's adding domestic exposure on top of the export names.
So what else do you like besides HDFC Bank, David? What IT names? I'm guessing when you mean exports, you are talking about IT as well as pharmaceutical companies.
Absolutely. We also actually like a company like Motherson Sumi. So we're talking about the whole auto chain sector, which also is growing stronger in India and is becoming a global player. In terms of export names, you mentioned the IT names. We still favor TCS over Infosys. We were not so much convinced by the set of results by Infosys, not in terms of momentum, but more in terms of its quality. And we question whether this is sustainable. So we would rather stick with a play like TCS. Talking about the domestic names, we are very much interested into Reliance Industries. And the set of results that was published actually is actually extremely encouraging. It's mostly coming from the downstream part, but we see room for further positive news coming out from the upstream segments in the coming quarters, and the combination of the two should lead to a further and a long-awaited re-rating of Reliance Industries in the sector.
What is your current net exposure to Indian stocks? Can you tell me in dollar terms?
Net exposure, I wouldn't tell you because we manage several funds, across. So we've got global funds which are invested in India. We've got Asia funds. We've got dedicated India funds. So we've got a whole range of funds which are active in India. But what I can tell you is that within all those segments, all those funds are currently significantly overweight India.
Happy to own Reliance, TCS, Motherson Sumi, some of your key holdings, irrespective of the election outcome, or before 16th of May, you could be looking at selling some of your Indian stocks?
I don't know whether it's a good thing or a bad thing, but we tend to have a long-term horizon. And, we know that political events take place every 4 or 5 years, and this is how democracy works. So we actually always pay attention to the results, to the programs, to the candidates, but this doesn't, most of the time, change our overall long-term strategy. And we welcome actually those elections. We think that it's always interesting to see where a country is heading and what the population is thinking, but we don't see any reason to apply any massive premium or discounts. So when the market gets too optimistic or too positive or in reverse too negative, we try to maintain a constant line, and that for that reason I don't see us changing significantly or exposure right now. The mix of stocks is not going to change. What could change probably is maybe the overweight, which could increase further if really we feel like reforms are carried on. But we've got another year probably before we make such a call. Election are one thing, and then the execution is another thing.